Are you tired of broken promises and delays? Want reliable and forward-moving capital? Life companies could be your ticket to the finish line that has no surprises to it. When you think about going to a life company or you're trying to make a decision when it comes to a bridge loan, you want to think of an architect. And an architect spends the time to design and frame and build and think through those things versus just those small handyman fixes that try to come in and throw a band-aid on something that isn't going to work. So you've got to plan first and then move fast. And life companies prize clarity and they prize discipline. You got to have more prep. You're going to get more dollars and you will have faster closings if you do this in advance. A simple map for a life insurance company bridge is I'm going to give you 5 practical tips, field tested, and a checklist to reduce the chaos for today. So life companies will actively finance bridge or transitional loans, and they are usually going to be somewhere in the 65%. Now, you'll hear them represent that they can maybe go up to 75 or 80. It's probably a stretch after they do their underwriting. Not to say they couldn't possibly go up to 70 or 75. They are asset-based tools to support the collateral clarity. And remember, the key metric is the debt yield in order to get to that. And we'll talk about that as we go through this. So 5 tips to maximize your proceeds. Tip number 1, lead with debt yield. What does this mean? You take your NOI, the net operating income, and divide it by your loan. Show some cushion and path. That's how they're going to know whether dollars they're going to do. They might be in the 7 to 8% debt yield. Reverse engineer that, spend some time looking at that number because it's another way they do it versus just debt service coverage ratio. Tip number 2, prove the debt service and a realistic LTV. Remember, you've got to be in that 65 to 70% range after you've done a little bit of scrubbing on the project, which means you got to have some vacancy in there. You got to make sure your expenses are appropriate. You got to put in some reserves underneath that before you get to net cash flow. It's the same thing they're going to do as well. Tip number 3, show a crisp transition plan. Lease-up milestones need to be laid out, capex, timelines, accountability. Make sure you understand what your transition plan is. Number 4 is pre-size the capex and interest reserve. Look at the scopes, look at the draws, look at the contingencies, and make sure that you reverse the math to get into there. And finally, tip number 5, map the collateral and the liquidity options. So you might look at the inventory or the equipment or backstops. But the reality is you need to know your numbers really well. You've got to be able to have communication that is clear and it's simple and set expectations, build trust, and then regain the freedom ultimately. What it looks like for you is the transitional future fundings and the extensions are going to be best suited with you being prepared. The bridge across different sectors are very, very important right now. And they're starting to extend credit to those people who are prepared. So have a one-pager, have your plan and your timeline, make sure you understand your debt yield and your debt service sensitivities, have your capex schedule and your interest reserve model, have a collateral map, the account and the inventory, etc. Fit to the box of the LTV and the terms and conditions. Make sure you can do that and give weekly updates and be responsive to them as well. Look, simplicity wins, clarity beats the chaos. Communicate, align, and close with confidence. And if you have any questions for us of how we can help assist if you're trying to get a bridge loan, reach out to us at integrity-capital.com.